Okay, let's dive into this. The data right now is showing a market setup that is just heating up incredibly fast. In June 2026, it's shaping up to be one of the most opportune, really extreme months we've seen in recent market history. So in this explainer, we're going to break down three high catalyst stocks that our research shows are perfectly positioned for this exact moment. Now, these aren't just random darts on the dartboard. Every single one of these companies possesses a massive competitive moat, they sit at highly compelling valuations, and they are absolutely packed with the kind of forward-looking catalysts we love to see.
But before we reveal the specific companies, we really have to address this massive recurring question, right? How do you actually find the next 10x stock before it makes its run? Look, it's a completely natural investor desire. We all want the perfect fast money stock. Zero risk, zero volatility, literally no bearish articles written about it anywhere. People want an obvious slam dunk that'll multiply their money by next week. But here's the reality check. Waiting for that level of absolute 100% certainty, it guarantees just one thing. You are going to miss the massive gains.
So here is our roadmap for today. First, we'll cover the mindset for catching stocks before they run. Then, we're looking at three companies solving the AI megatrend: ServiceNow, Zeta Global, and Fluence Energy. And finally, we'll wrap up with how to actually seize the 2026 opportunity. Let's get right into it.
Catching stocks before they run. The myth of zero risk.
If there is literally one rule to take away from this, it's this. To get massive returns, you absolutely must go against the grain early. If an opportunity is obvious to everyone, I'm telling you, it is already run. Let's just look at Applied Digital for a second. When that stock was sitting at, $4.53, the thesis was incredibly clear. Massive AI data center demand was coming, and they had the infrastructure to fulfill it. But the bears just hammered it. Financial media was screaming that AI was a bubble, they were calling data centers a scam, but the investors who had that early conviction, despite all that incredibly uncomfortable noise, they saw that stock run past $47. That's a clean 10x gain. Today, the average investor finally loves the stock, but guess what? They've completely missed that massive speculative upside. To win big, you've got to position yourself way before the crowd catches on.
Moving on to ServiceNow, the cash machine, accelerating at scale.
So while software as a sector might feel like it's taking a bit of a back seat right now, ServiceNow is presenting a massive value recovery play. To really anchor this cash machine narrative, just look at this number, $1.67 billion. That is the amount of operating cash flow this company threw off in a single quarter. I mean, wow. Unlike a lot of today's hyped-up momentum stocks that just burn cash endlessly, ServiceNow operates with some serious, incredible financial discipline.
There are really four specific catalysts that are driving ServiceNow's incredible upside right now. First up is that massive cash flow we just talked about, and that's supported by a really beautiful 32% operating margin. Second, they are actively defying the law of large numbers. Usually, for a $14 billion revenue company, growth is supposed to slow down, right? But their subscription revenue is actually accelerating, hitting 22% growth recently. That's huge. Third, they are turning AI into actual real money. Their large customers, the ones spending over $1 million a year on their Now Assist AI product, that segment grew more than 130% year over year, and they're targeting $1.5 billion for the year. And finally, management has laid out this clear, long-term roadmap to hit $32 billion in revenue by 2030, continually expanding into new markets like cybersecurity.
Next up, Zeta Global, AI marketing growth, consolidating the stack. Now, what's really interesting about this is
when a company truly hits its stride, the data just becomes undeniable. Zeta Global is essentially using AI to sift through massive amounts of consumer data, predicting what people actually want and automating marketing across all channels. And the results? Headline revenues surged 50% year over year, hitting $396 million in Q1. And get this, even if you strip out their acquisitions and political spending, their organic growth still accelerated for the fourth straight quarter to 29%.
And look, this is not just some one-off lucky quarter. Zeta has topped and raised its own revenue guidance for 19 consecutive quarters. Seriously, let that sink in for a second. That is nearly 5 straight years of management structurally underpromising and consistently over-delivering. The broader markets are finally starting to wake up to this beautiful track record, and that gives this stock some really significant short to medium-term upside potential.
The actual mechanics behind all of his growth are just fascinating.
Their unified Athena AI platform, it isn't just some shiny new toy. It's actively replacing legacy blue-chip tools. They are successfully ripping out massive competitor workflows, think giants like Salesforce, because frankly, companies just no longer want to juggle a dozen different marketing tools. And most importantly, all of this market capture is actually translating directly to the bottom line. Zeta is rapidly narrowing its net losses and is guiding toward positive GAAP net income for the full year. And if you know the software world, you know that when a high-growth company finally flips that profitability switch, they tend to get structurally re-rated much, much higher by the market.
Let's transition to Fluence Energy, powering the future, the infrastructure bottleneck.
Okay, right now it feels like absolutely everyone is fiercely chasing AI hardware, right? Data centers, base-level chips, you name it. But people are completely overlooking a massive, literal bottleneck. Where does the electricity actually come from? If a hyperscaler goes out and buys the most advanced, cutting-edge AI chips in the world, but they cannot physically power them, well, they're just the world's most expensive paperweights. A single AI data center can pull as much electricity as a small city.
And this creates a literal nightmare scenario for these tech giants. When they go to a local utility for a power hookup, they are often told, point blank, that it'll take 2 to 5 years to complete, meaning billion-dollar data centers are at threat of just sitting idle, bleeding cash. Enter Fluence Energy. They build grid-scale battery storage. So while local utilities are taking years to complete hookups, a Fluence system can be operational in a matter of months. They are effectively selling these companies the ability to turn the lights on now. In this massive AI race, skipping years of waiting is a competitive advantage that companies will absolutely pay top dollar for.
There's this really punchy saying going around the industry right now that I just love. It's not the bit that's hard, it's the watt. And that perfectly grounds all these abstract high-level cloud concepts into harsh reality. Software and chips, they can be engineered rapidly, but generating and managing grid-scale electricity, that is incredibly complex and slow. The power supply is the ultimate bottleneck to the entire AI revolution, and Fluence is perfectly positioned to solve it.
But you might be wondering, is this just a nice story? Or is there actual proof of concept here? Oh, it is absolutely proven. Fluence actually supplied the massive battery system for Meta's 11-mile solar and storage project in Arizona to support a giant data center. Over 2,000 of those battery enclosures came straight out of Fluence's very own factory in Utah. And this isn't a one-and-done deal either. Their CEO recently noted a global data center pipeline exceeding 30 gigawatt hours. They're even doing something incredibly clever. They call it a gas bridge, where they're pairing their batteries with large natural gas companies to get data centers online before the massive power turbines even arrive on site.
So the absolutely crucial point here is why this stock is poised to jump from its current $18 price point. Well, we've got 4 major structural catalysts. First, the market itself is just exploding. The 2026 battery additions driven by AI demand are going to be massive. Second, they are sitting right on the doorstep of profitability, which, again, triggers that sweet valuation re-rating we love to see. Third is their home field advantage. Having established U.S. manufacturing provides a protective moat against things like supply chain anxieties, tariffs, and executive orders. Hyperscalers need a secure domestic supply, and Fluence neutrally benefits from that entire landscape. And finally, the technical setup itself. The stock actually has high short interest right now. That means if the good news keeps rolling in, those bets get squeezed, which pours absolute fuel on a massive upward move.
Seizing the 2026 opportunity. Connecting the dots.
And this brilliantly illustrates the point we discussed at the very beginning. If you've been following the AI power theme at all, you've probably seen Bloom Energy go on an absolute monster run. But here's the difference. While Bloom Energy is on, say, Chapter 10 of the market's waking up to its potential, Fluence Energy is literally just starting Chapter 1. The exact same rising tide tailwinds apply here, but Fluence just hasn't run yet. The market is still discounting it, which makes it an incredible early-stage opportunity compared to that late-stage crowded hype.
So I'm going to leave you with this final, provocative thought to apply to your own investing strategy. Are you chasing late-cycle hype where the trends are already totally obvious and priced in? Or are you actively positioning for the next wave of massive catalysts? The setups we've covered today in this explainer, ServiceNow's cash machine, Zeta Global's AI growth, and Fluence Energy's infrastructure dominance, they offer a really compelling framework for finding real structural value way before the rest of the market catches on. Use this to guide your own research as we head into what is going to be an incredibly exciting 2026.